The feasibility analysis is part of your due diligence. This is where you do all the number crunching and decide the viability of the project before proceeding with the development. At this stage, we're assuming that you've done your research and have a pretty good idea of how many units you're going to develop, the average size, and also what sort of money you're intending to spend on building these units. Now, it is very important at this stage that your proposed development is based on what the market wants, irrespective of your personal preferences. Now, here you should do some what-if analysis as well. By that, what we mean, you should be able to reduce the size of the units and see what it does to the bottom line. Also, you can try and reduce the number of units and increase the size and therefore the selling price and see how it affects your profit margin. We found from experience that it's a very time-consuming exercise and it's very important you don't miss anything, and therefore we have developed a cloud-based software package which is called feesreport.com.au. And on the screen is just some of the outputs that you get. I'll briefly just go through what they are, and then we'll have a look at the live demonstration of software. So the first thing is obviously the gross sales revenue, and that would include the total development sales, including your rental income. This is, if obviously the site that you're developing has got a rentable property on it. The selling expenses would include things like the percentage you pay to the selling agent, including the marketing costs and also some conveyancing. Then obviously the land cost. This is how much you're going to pay to buy the land. The purchasing cost includes things like your stamp duties, your legals, etc. to settle the land. The next is your total development cost. This includes the direct building costs which you pay to the builder, but this will also include your demolition costs, your engineering, landscaping, and everything. So it's a total development costs, including the management fee if required. The next thing which we highlight here is the interest charges. So this is the amount of money you need to service the loan. And the last one is your GST adjustment, which is the difference between the GST collected and the GST paid during the construction. And once you subtract all those expenses from the gross sales revenue, you come up with your profit margin. And in percentage terms, in this example here, we have 26%. And this is important that anything above 25% is considered a viable project. Now also our software package allows you to work out the total cash required to undertake the project. These are things like the deposit you need to acquire the land, also some of the equity you need to put to get the development costs. Now here we also will calculate the total interest required to service the loans. The purchasing costs, obviously this is something you can't borrow from the bank. These are stamp duties, legals, etc. Permit costs, these are professional fees you pay the architect and the town planner. The subdivision costs, this is important as well. Sometimes the banks actually will ask you to subdivide the land, so this may or may not apply. The maintenance costs will be applicable if you have a rentable property, and you might incur some maintenance costs while it's being rented out. Now the selling costs here exclude the actual the commission to the selling agent. These are purely for things like marketing material, advertising, and all that sort of thing that you have to pay. And the last one is a management fee. This is when you engage a third party to manage the project. Again, you might be required to pay that out of your own pocket, or you can incorporate it into the total development cost and get it from the bank. Okay, now I'm just running our software live. So what we've done, you press the new, and then the system gives you opportunity to put in the address. Once you've entered the address, then you choose the land cost. It's a drop down. So in our case, it's 720. The land size, you can pick up the size of the land. So in our case, it was 740. So we'll leave it at that. Number of units you're going to put on that property, 3. The average selling price of each unit, which we've done the research and we know, and here you can actually change it, but we'll leave it at the 720. The cost per square meter, this is direct building cost. That doesn't include things like landscaping, demolitions. This is purely to construct the dwellings, directly paid to the builder. The unit size, this is obviously excluding the garage, but it's 140 square meters, which is, if you add your garage, it's probably about 17, 18 squares. The rental weeks, here if it's a rentable, if there is a rentable property on the site, because this will be added to your income. So approval is required. This is where you decide, whether you need to go and get a planning permit, or it comes with a planning permit. Selling costs, if you are going to sell the finished product, so this is important as well to choose yes or no, because this will calculate the commission you have to pay to the selling agent and your selling costs. Site finder fee, sometimes you will engage somebody to actually go and find you a site, and there's a fee associated with that. So in our case is no. And the last thing is the council, and you have to select which council your development is in, so the system will correctly calculate the levies, the open space levy, etc. So once you've done that, all you have to do is just press calculate, and the system basically works out all the amounts. So here we can see it's worked out what the gross selling revenue is, the selling expenses, and it's come up with a 27%, which is fairly viable project at this stage. Also, the system is telling us, even if you went up with your land value and paid up to $750,000, it's still a viable project. So let's have a look at some of the more detail and how the system came up with these amounts. Here we can see what is done is worked out the direct building cost, which is based on what you have to pay the builder to construct those 3 dwellings. The selling price, this is for each individual unit. The mortgage that you have to borrow from the bank for the land, and this is the amount you have to borrow for the construction. Your rental income, the GST adjustment, it's calculated that. The site finder fee, which is nothing at that stage. The finance cost, the settlement costs, which includes like your stamp duty on the land, the rates and taxes, the water, the sewage, the electricity you have to pay. The next lot is your total development costs, which includes your direct building costs, your finance establishment fees, the working drawings, the quantity estimation, structural engineering, building survey, traffic. So it goes right through the demolition cost, the fencing, the landscaping, the water contributions. The next heading is your planning permit, which includes things like your drafting, the land surveying, the town planning costs, landscaping design, subdivision costs, and so it goes. And the last step is obviously here is your total cash is required, which is your the equity that you need to secure the land, and the equity you need to get the construction amount, etc. And also it gives you the return on your cash, which is quite healthy. This is basically, works out based on the amount of cash you put in, the amount of cash, the net profit you make. And there's some other calculations here, which is your open space contribution, land tax, and stamp duty, etc. Now, I can quickly show you, if you went back and said, look, I want to do a what if analysis, and I want to see, we can't get 3 units, but you can only get 2 units. So you change that to 2 units. Obviously, if it's going to be 2 units, the price per unit is going to be higher. So we'll increase it. We'll say we'll go to, say, 820. But obviously the size is going to go up as well because the price has gone up. So we'll say we'll go to 180 square meters, and everything else stays the same. So you say recalculate, and you can immediately see that the margin is very, very low. So you can't get any. You won't be able to get finance. So this is the what if analysis comes into play. So really, what you have to look for is obviously try and sell it for more than 850. So maybe we'll try with, say, 920 and see if it makes any difference. Now, even at 920, it's still, not within a viable range. Now, you have to ask a question at this stage whether it's worth doing because, obviously, in this area, you have to, 2 units just don't work. So you have to go back to your to original 3 units, and irrespective of what the town planner says, what the architect says. Now, if your original thing was 3 units, you go back to your 3 units, and at 150, and that's a viable thing. Now, I'll just quickly show you some of the assumptions that the system makes. This is the minimum return. This is land equity percentage. Now, obviously, if you want to borrow more or less, you can adjust it here. Say in this example, I want to adjust, I want to borrow, 65%, not 80%. So you can adjust it there. And similarly with construction equity. Now, some of the percentages, that could be lower. Instead of 6%, could be 5%. The stamp duty, you can adjust the things here, and it just shows you, drafting per unit. You might have a friendly draft person that does it for a better price for you. And these are all the things that you can readjust, and all you do is just say calculate again, and basically that's how quickly it does the calculations. And basically all these worked out automatically. And what you can do here is you can go back and say, look, I've got a builder that might be able to build it for less than 1,400 a square meter. Perhaps, go to 1,300 square meters, see what it does to the calculations. And you can quickly see that it's hitting the 30% mark there. And the other thing you can do is you can actually get it into a spreadsheet. So once you hit this button, it will actually download into a spreadsheet, which you can do further manipulation. You can open it as a spreadsheet. The other thing you can do here is you can actually produce a PDF file, which then it puts it into this format, which then you can email it to yourself or you can print it. So you can see obviously the assumptions that were made, how much you're going to pay for the land, how many units we're proposing to do, and what is the cost of construction. Gives you the results, which is the quick summary, and then it gives you all the details. And at the end, it even shows you some of the assumptions that we made to work out all that. So this then, it can be printed or it can be emailed, and you can go and try the next one. And that's basically how quickly the system does all the calculations for you. And hopefully you would get great benefit from it. And we be happy to get your feedback and to make it to incorporate any improvements that you might suggest. Now, the other very important thing at the conclusion I want to say is fairly custom. It's very customizable. So if you have your own preferences, our programmers can incorporate your changes and make it a customized version for your particular situation. Thanks very much for your attention.